Tabb, founder and CEO of the Tabb Group, and we are a financial markets research and advisory firm really focused on institutional capital markets. The state of high-frequency trading, it's actually in a interesting position. There's a lot of notoriety about it. There's a lot of interest in the general market about it. There's a lot of press. There's a lot of regulatory scrutiny about it. But actually, the high-frequency traders are actually making less money than they've ever made before, and the size of the high-frequency pie is getting smaller and smaller, mostly because broker algorithms are getting better, brokers are getting much better, and investors are getting much better at being able to interact with this order flow. And I think the level of technology and the level of the brokerage business is getting higher. It's changing. I think when you look at, I think we need to look at different definitions of high-frequency trading in different marketplaces. Okay, so if you're looking at the U.S., the chance of a flash crash occurring right now is actually pretty low. We've implemented circuit breakers and what they call limit up, limit down bands, so that if all of a sudden the market starts dropping, or actually on the other hand starts raising, the market actually shuts off, and so that we can regain composure, figure out what the right price is, and start trading again. So the chance of a flash crash in the U.S. is much lower. In other markets, it's harder to say depending upon which market and what's going on. Now, that said, is the technology infrastructure of the marketplace is actually getting worse. We're seeing more market centers have problems. In fact, today there was just a problem in the U.S. options market. We've had problems with the market data distribution platform. We've had problems with exchanges going down. And to a certain extent, that has to do with just the complexity in the marketplace and the difficulty in testing a lot of this technology infrastructure, as well as to a certain extent the economics, especially on the equity side. The economics are pretty brutal, and so it becomes hard to have as big a staff as you probably need to test and vet and develop all this infrastructure. We are not approaching it. We are past that. We've reached there 3 or 4 years ago. Right now, machines are operating in the U.S. and in Europe at the millisecond and to a certain extent the microsecond level, which is 1,000 times smaller than a millisecond. And sometimes we're hearing of market data technologies operating in smaller in nanoseconds, which is 1,000th of a microsecond, which is unbelievably small. And so the only way to interact with this type of information is with machines. And so now that sounds very scary from a human standpoint, me sitting at an internet connection trying to buy 100 shares or 1,000 shares of a stock. But actually that order gets managed and submitted into the market with very sophisticated infrastructure. So it's not, there is generally not as much worry. There aren't people in the center of exchanges anymore matching my buy with your sell. It's all being done by machines and high-speed order routing and all sorts of analytics behind the execution. But it is absolutely machines fighting machines. What kind of regulation works for this is actually a very good question. The regulators are very under-equipped to surveil markets that operate at this type of latency level and this type of transaction level. It used to be large blocks were done on an upstairs basis. I'll sell you a large block of Petrobras, and you buy a large block of Petrobras or whatever, and the regulators could they could see what was being done. Now that large block of stock is being broken into very, very small shares, and it becomes hard to figure out how do these 100 share or even to a certain extent 1 share trades equal this million share order. It's just very difficult. So the regulators need much better technology, audit trails, market data infrastructure, so that they, as well as you know, linkages to know that my large trade was broken up into 10,000 smaller pieces, and these were all of the executions that occurred. It's a very difficult environment where the regulators are absolutely outgunned and outmanned. Now that said, it doesn't necessarily mean that there's a ton of fraud going on in the market. That to a certain extent, especially in more liquid stocks, the more traders you have, the harder it is to manipulate the market. There are more people looking at the market, there are more people analyzing the market, and when the market starts moving one way or the other, when somebody tries to push it abnormally higher or lower, there's going to be other people to jump in to bring it back into the right place. And all of this happens in less than the blink of an eye. So, is it perfect? Are there only good actors in the market? No, but then the market was never comprised only of good actors. That said, the cost to trade has gone down. The cost to get in, to get out of a position has gone down, and to a certain extent, the ability to directly interact with trading flow has gotten much better given the machines.